Don't forget to subscribe to the Retire Young podcast on Apple Podcast, iHeartRadio, and Spotify. If you're just tuning in, Al was shedding some light on opportunities utilizing the financial markets and, how we can react or, how we control our emotions in these financial markets. So we can't control what's happening, but we can control how we react to it. So, Al, as we get into this segment, we have a lot of listeners that want to understand more about how the institutions or the successful traders are creating income with the stock market. Mm-hmm. Now, the stock market is a phenomenal asset class to utilize, and there's different ways that it can be used. It can be used for how institutions use it for income. They also use it to build wealth. So let's talk about how they are utilizing the stock market to create income in their portfolios.
Well, the stock market probably is the best vehicle ever created that gives everybody an opportunity to participate and to hopefully create wealth over their lifetime. But there's a difference. Most people, unfortunately, have their involvement with the stock market through mutual funds. And that's what Wall Street typically will put people into. And that's really not where the greatest benefit can be achieved. Because we talk about this all the time, where the market does not just go up. It goes up, it goes down, and it goes sideways. With a mutual fund, the only way that you can participate with stocks in a mutual fund is in an upward moving market. Mutual funds can't short the market, which is a way of making money in a down market. They can't go to all cash. There's a number of disadvantages there that kind of take away the advantage of being involved or invested in stocks. Stocks are really a necessity for long-term growth, for your retirement, for the development of wealth, if that's what your goal is. But there are ways of utilizing stock where you can benefit in not just an up market, but in a down market and a sideways market. And unfortunately, most people are just looking at kind of putting together what we call a buy and hold strategy, where you put together a portfolio and you're told by a financial advisor, this is a long-term deal here. Then you hold on to it for decades. Don't worry about these drawdowns or corrections. Well, you should worry about these drawdowns and corrections, because every time a portfolio goes down in value, whatever it went down in value, you have to be up more than that just to get back to where you were before. If a portfolio is down 50%, it has to be back up 100%. You have to have 100% growth just to get back to where you were before. There are ways of using a stock portfolio where that can be protected. It's basically an insurance policy. What if nothing is happening? If it's just a flat market, there's also assets that you can use along with your stock, with your equity position, to actually benefit in markets like that. And the ironic thing and kind of frustrating thing is that Wall Street puts most of their clients into mutual funds or maybe annuities. They're taking advantage of stock in all three directions in the market, and then they're utilizing these other assets that we talk about for more short-term benefits, futures, forex, and options.
Yeah, before we get into those other markets, think about that. If a broker or an advisor is putting their client into a one-directional strategy, and there's three directions, that you're kind of losing the whole meaning of using the market. There's multiple directions, so you need strategies for every direction.
Well, it's about putting odds in your favor,
Yeah.
and if you're looking at a 1 out of 3 chances of benefiting compared to 3 out of 3, there's a big difference there. And it doesn't take a math genius, which I'm not, to figure out that 3 out of 3 is better than 1 out of 3.
Well, how does an individual, so let's just say somebody does have stocks, how do they, is there ways rather than the buy and hold to collect, I guess, have a sell order to collect profits? Is there ways to do that?
Well, and that's one of the problems with the typical buy and hold strategy. It is a strategy where you put together a portfolio, you buy a position, and then you hold on with no regard to profit or loss. And I think everybody would agree that there's nothing out there. There's no stock that just goes up every day, that never has a pullback and never goes through a correction. When we have a bear market, back in 2008, let's use that as an example. The S&P 500 is comprised of 11 sectors, which really cover every sector of our economy. In 2008, every one of those 11 sectors was down in value. So, the idea of being diversified within different sectors, that doesn't always work either. But there is a way of protecting what you have, a stock portfolio. So if, say you don't want to actually sell a position, you can still have it protected. So even though the stock goes down, you're hedged so something else will go up in value, so your overall portfolio is protected.
The good thing we talked about in the first segment about these platforms is they are very sophisticated. And just, if when institutions or the successful, when they're utilizing the stock market to create income, they're opening their positions, but they're also closing them to take their profits. And
Correct.
Us as investors can do the same thing with the stock market. We don't have to rely on somebody else to do that. Al, we're actually having a lot of people, a lot of people come to these investing classes right now that want to understand these other markets as well. We know the stock market. We kind of broke that down already. Let's get into these other asset classes that you had mentioned: the futures market, the Forex market, and the options market. Why are the institutions also not only using stock, but also using these other asset classes to create income?
Well, the institutions, the pros out there, the big firms, Goldman Sachs, J.P. Morgan, people like Warren Buffett, they look at the market as a way of creating wealth for them, generating cash and creating wealth. So they're going to take advantage of every aspect of it, every part of it. And when you look at companies, some of these companies make the majority of their profits through trading their own money, maybe trading some of their clients' money, but they use things that they don't necessarily put their own clients into. We talked about stock. They use stock. And by the way, from a profit standpoint, you don't have to necessarily sell something to generate a profit from it. And that's where options come in. Options can be used as protection, as an insurance policy. Options can be used to kind of supercharge the returns you get from a stock. You can actually, if you want to take a position, you can get paid cash using options to buy it at a lower price, or get paid cash to sell it at a higher price if that's your goal, is to get out of a position. But the institutions are using futures, Forex, and options in addition to stock because of a number of things. Number one, futures and Forex trade 24 hours a day, so that gives them a lot more trading opportunities, and it gives anybody the opportunity to do this any time of the day or night. And then probably the number one benefit is leverage. And I know a lot of people that have heard of somebody or know somebody that has traded with leverage, probably know somebody that hasn't done well, so they fear it. It's not something to be feared. The real risk is not in that particular asset, it's in the person trading it. So if you understand how they work, if you understand how to control the risk part of it, that's the most important thing. And what we teach our students is to identify the maximum amount of risk you're willing to accept for any trade that you do, any trade or investment. And then that's it. Maybe it's $100, maybe it's $50, but that can be a chosen number. But the leverage is huge on the upside, on the benefit side. Now, basically what we're talking about is just making your dollars stronger.
Being able to control more of the market with that dollar amount.
Well, exactly. And the institutions do it because they can control parts of the market with smaller amounts, smaller investments, and maybe spread their money out even more. We're talking about leverage of maybe anywhere from 10 to 1 to 50 to 1 to maybe 100 to 1, which means that every dollar that is invested in a position controls a multiple of that dollar. That's maximizing the value of what you have. And as long as you control the risk, then that leverage really can be a benefit to anybody.
That's the nice thing, Al. The institutions utilize it, and the public, they don't know. It's also available to us. We can utilize this leverage.
Absolutely. And then if the institutions are not just positioning themselves for long-term growth. In other words, they're not putting together a position and then they're going to wait 20 or 30 years to try to reap a benefit from it. They're looking at maybe getting a benefit on a daily or weekly basis. And there's a lot of people out there that right now maybe are in a position where their job is gone. Maybe they've been laid off. Maybe their salary has been cut. Maybe they're questioning what's going to happen on the other side of this whole coronavirus issue. We always talk about the successful people in this country, actually in the world, having multiple sources of income coming in. And a lot of people look at these markets as a way to do it. The institutions
think
are
of
doing
Buffett.
that.
He's looking at the market. He doesn't only own business. He uses the market.
Yeah, Warren Buffett probably makes somewhere between $7 and $8 billion a year trading options. Yet his advice to people is do the buy and hold. Basically, I think he's saying just buy companies he owns and hold on to them. But that's not necessarily what
Smart
he's
guy,
doing.
huh?
Exactly. But we've talked about this before. But if you have a bill that is due now or an emergency situation, you cannot wait 10 or 20 or 30 years to pay for it. People need to have the ability to do that now. And that's where these short-term vehicles come in. That's what futures Forex are. They can be used as really great short-term trading vehicles. Futures probably the best one for people that might be looking at benefiting on a daily or weekly basis. So typically you will get into a position and out. It could be in the same day, maybe 2 days. With the Forex, maybe you're looking at a few days to a week. That's part of a plan, and it's part of what anybody who is going to participate in the markets, whether it is buying stock or utilizing any one of these other assets we're talking about, needs to get used to not sitting in front of your computer. If you do that, you will overthink things. You let your brain and your gut make the decisions for you. And people might be saying, well, you don't want your brain to make decisions? Not really. We want you to follow a set of rules that have been set up by these people that know how Wall Street works. Follow that step-by-step set of rules, and it takes that thinking in the emotional part of trading out of your world, which you really need to do if you want to have any kind of consistency in the financial market.
Yeah, one of the great things you were talking about these markets being 24 hours, I don't think a lot of our listeners caught that. I mean, these markets are open 24 hours a day, around the clock. So the majority, I would say a lot of our listeners probably work during the day, so they have the opportunity to be traders or investors in the evening. So you can trade and invest any time of day because it's open. And Al, we talk about these multiple asset classes. I mean, I like to play a lot of sports, and probably because I'm very competitive. That's why I like the financial markets. But think about it. Baseball's back. Think of it as a pitcher. If a pitcher only has a fastball, do you think they're going to be a very good pitcher?
No, people will get used to it. They'll know exactly how to respond to every pitch.
Exactly. So you have a fastball, you have a curveball, a slider, a changeup. If you're like me, you also have a knuckleball. So you have many different tools in that tool belt. That's why it's important and why the institutions or the successful investors utilize these multiple asset classes. They use stock. They also use options. They use futures and they use Forex. So there's more opportunity. So Al, you talk a lot about these other asset classes. We all know stocks. Well, you talk about these other asset classes like the futures market, the Forex market. Don't forget to subscribe to the Retire Young podcast on Apple Podcasts, iHeartRadio, and Spotify. Be sure to leave us a review and different topics you would like to hear next. Coming up next, Al, we're going to get into retirement and retirement techniques and strategies that the institutions like to utilize. This is Josh and Al. We will be right back.